Welcome to the Energy Desk, a limited series from Mobius Risk Group on the macro and fundamental trends shaping global energy markets. If you like what you hear and you want us to keep this series going, make sure you let us know by following wherever you get your podcasts or dropping a note to amelvin@mobiusriskgroup.com. Let's hop in. Welcome back, Zane. Good to see you.
Hey, you too, Alex.
We got some interesting stuff this week. I've got a big topic on nuke, and then we're going to be talking about some OPEC-related happenings in the world. So, where do you want to kick this off?
I would just start with a fun comment, just to me, state of the markets in general and avoiding OPEC and nuclear fired generation altogether. It's an interesting world where natural gas often ends up being the stepchild until it's not. It had its moment in the sun in 2022. And I think our topics today are yet another example of that. Certainly nuclear fired generation capacity will have a read-through to the natural gas markets. However, for those that are exposed to and most interested in global natural gas markets, domestic natural gas markets, not to fear, we'll have plenty more to say in the coming weeks. But today we will stay centered in the realm of OPEC oil markets and spend some time on the nuclear fired fleets around the world and maybe get a little close to what that means for natural gas markets. So I think, with OPEC, there's been some really interesting news in the last few weeks, and interesting mostly in that it's not really interesting, yet the market found it as such. You just go back as recently as last Friday, and there were headlines that, in some ways countered the expected Libyan news that was discussed last week. And it was OPEC is going to begin bringing their barrels back in Q4. They have been significantly curtailing since October of 2022. So a nice round 2-year stretch, October of 24, they were supposed to begin bringing barrels back online. They had said this for many, many months. So this was no surprise, yet on the heels of Libya reportedly having come to some near-term agreement between the two, I'll say, warring factions in the East and the West. The OPEC news took the front of the WTI curve, and certainly with the recent tight linkage between Brent and TI, global oil markets came crashing lower on Friday. And early this week, we made comments in some of our daily reports. And for those of you out there that do not subscribe to those, there's a way to keep up with what we're seeing, what we're thinking, what we expect to come next prior to your weekly Friday podcast. And so early this week, the news was that OPEC was considering delaying some of the return of their expected gradual increases beginning in Q4 of 24 or in as little as a few weeks. And that helped to lift the market out of the downward spiral that began last Friday. Now, again, this news was telegraphed. We had known it for many months. Our view at the time and written about in our daily write-ups was that unless there was going to be at least a quarter's long delay, that it likely would not have much of a market impact. And in fact, if it was only a 1-month delay, it might lead the market lower, so as to point the market to this, we're waiting, but we're pretty impatient sort of stance. And of course, neither one of those was right. They came out with a 2-month delay. And now they have said it is not going to be a quarter, it is not going to be a month, it is going to be squarely in the middle. And the WTI market has begun to bleed lower on that news. And a couple of additional details in there. When you look at the official release issued yesterday by OPEC, there was a specific call out of the overproduction by the Iraqis and Kazakhstan. Well, that overproduction is just a piece of what you see as OPEC barrels running above the voluntary cut levels that have been announced. That data, that table that's available on OPEC's website, when aggregating all of those countries that are participating in the voluntary cuts, one would find that we're currently, meaning as of August, already running about 1 million barrels a day higher than the voluntary cut levels. So what does the delay actually mean? while we continue as a global oil market, wait for the demand that has been promised yet never seems to show up. A 2-month delay doesn't do a whole lot. And then, my final thought, and certainly happy to field any questions you have on my ramblings here, Alex, is today's news, which in my opinion is the catalyst for yet another leg lower and now a new low, a new 1-year low at the front of the WTI curve, where these 5 minutes at 11:51 Central Time on Friday, September the 6th, the October WTI contract is trading about 67.5. So another meaningful leg lower. Why? In our view, and certainly with Brent moving down faster than TI this morning, it would be the release of OSP data, or official selling price data, for October. Late last week, and actually I think even in the middle of last week, it was one of the topics we flagged for our clients and some of our strategy materials. Was next on your list of things to be wary of is Saudi OSP data. Well, Saudi OSP data has been released this morning, and we see yet another month-on-month decline. Saudi barrels headed to Asia, those of the light variety, fell 70 cents to plus 130. And you've got across the board declines, some minor, such as a Saudi barrel headed to the US only fell 10 cents a barrel from plus 410 to plus $4. However, some, even greater in magnitude, where a Saudi barrel headed to the Med are still headed towards Europe, but not necessarily the Northwest European market is more of a, liquid trading hub. Those headed to the Med fell to plus 35 cents from plus $1.15. And the list goes on and on. Headlines about Libya cutting its OSPs as well certainly would lend one to believe that they will have the production squarely back online and consistently online in October. And so that reduction in OSP numbers, while the front of the Brent and the TI curves have, moved to recent lows, would suggest that either A, the barrels are actually going to keep bleeding in slowly, or B, could be that there will be no makeup from Iraq and Kazakhstan in the near term, even though it's been promised, yet promised by September of 25, mind you. Or C, and likely the most concerning point, the demand expectations are yet again getting kicked down the road. So I went on for a bit there around OPEC.
Yeah, there's really a few interesting levers there. First, I think it's worth commending you on last Friday talking about Libya's conflict-related disruptions. And you pointed out, that's a matter of hours and not weeks. And you were spot on with that. So that's one point. And I think maybe it'd be interesting to hear your perspective on those OSPs and maybe what that says about regional demand, kind of your third point there. Asia, taking a hit, Europe taking a hit, US taking, 10-cent knock, but the smallest of the three.
Yeah, I think the biggest signal is what you see in the OSPs on the light barrel headed to Asia. At this point, well telegraphed, Chinese demand has not lived up to expectations, where I believe Chinese crude imports are down 3 months in a row now on a year-over-year basis. Refinery runs are down 4 months in a row now on a year-over-year basis. And in many respects, over the last 10 to 15 years, so goes China, so goes global oil markets. Right. And China's in retreat mode. Fittingly, one would expect that oil markets are, at a minimum, not necessarily in, an upward trajectory. Now, where does that mean we go on the downside? I would say that most in the market believe that we are near an inflection point already for global supply. Almost comically, in my opinion, we are repeating once again what we said in 2014, that the Saudis need, $80, $85 a barrel to keep the machine running. Well, we all know how that worked out in 2014. For the U.S., I think there has been, some pretty significant gyrations in what is believed to be the marginal cost of the next U.S. barrel, and good for another podcast in the near future. But I'll leave it with an alternative fact that must be considered. Even if we were to need more U.S. supply, how would we get it to global markets? The demand profile in North America has been remarkably flat for more than a decade now.
Yeah.
We just consume what we consume. That's that. We find ways to become more efficient while we find pockets of new demand, and they largely offset. So,
yeah.
I think I guess in summary, the key synopsis here is it's a fragile market that's heading towards the end of the year where there's often some seasonality, some weakness at the front of oil curves. And none of that really has much to be carried through into 2025. If we are in a lower pricing environment, as CapEx is being set for U.S. producers, we very well may see some lower supply numbers coming out of this side of the world. And the big question mark, or the boogeyman hiding around the corner, is what does OPEC really have to give? Will there be a price war, and why? Also a good topic for another podcast. Otherwise, we'd go on for quite some time today.
Totally. Yeah. And there's really just two little points. We're not going to go into them for the sake of time, but the demand sentiment, kind of an early indicator that we've been watching, is how speculators have been positioning throughout the summer. And that has just been increasingly bearish. And so I think that really is one element that we've been watching, and I think is definitely relevant in today's landscape. And then the other side of the demand picture in North America, you see per capita consumption has just been in a steady decline since, the early 2010s. And so, again, just cementing your point there, where are those barrels going to go in the US or in North America? It's a question that needs to be answered. So I think that's, a good lay of the land for the OPEC side of things. And maybe,
well, my turn then. I get to kick one at you. So we'll stay in the realm of all things demand related. And in this case, let's go to the other side of the pond and head over to Europe. You had written a piece earlier this week, and I think it's a worthy topic to explore here. And it being the power sector and what was once thought to be the stalwart, the European industrial complex. And so with that, give us some thoughts on the German nuclear-fired power fleet.
Yeah, and this is a little bit of an extension from what we discussed last week about the tech giants and where they're placing their bets on power reliability going forward. But when we're looking at Germany's industrial outlook, we have plenty of signals of deteriorating conditions. We've kind of known about the deindustrialization trends in Germany for a while. And for listeners, just for context, Germany is the industrial center of Europe historically. But a lot of competition between Europe and Asia, and the cost of energy is increasingly becoming a friction point for European and specifically German producers. And when we look at some interesting research that came out this year, kind of comparing the cost of Germany's energy transition, which they call Energiewende. And really what that meant was phasing out nuclear generation and replacing that with wind and solar. It's really just variable renewable energies. And this analysis that came out this year was comparing the cost of Energiewende, which in subsidies and CapEx and OPEX really amounts to about 770 billion is the estimate between 2002 and 2022. So that 20-year period. And the benefit that Germany gained from that for their emissions reduction was about 25%. And instead, we compared the cost for Germany to keep their existing nuclear fleet that they had in 2002, which was supplying at the time roughly 30% of their total energy or power generation. And just to keep that nuclear online would have resulted in savings relative to Energiewende of about 664 billion, which really just reflects about $5 billion a year in operating expenses to keep that online. But the more interesting point that I think comes back to the US is, what if Germany said, okay, I have my nuclear fleet in 2002. Instead of shutting all of this down, getting it to zero by 2023, I'm going to keep that and I'm going to invest in doubling my nuclear generation capacity. And that cost would have been about 403 billion. Using estimates from Switzerland, France, and the United States. Average construction time, about 7 years, which, we can have conversations about that at length. But regardless, the savings relative to Energiewende, that 770 billion that they spent on wind and solar and variable renewable energies with subsidies, would have been about 403 costs, so $367 billion in savings, and they would have reduced their emissions by 75%. And so, again, to reiterate, Energiewende with wind and variable renewable energies cut their emissions by 22 to 25%. Keeping nuclear, doubling nuclear fleet would have led to emissions reduction about 75%. And why does this matter? Well, the balance of Germany's power generation is, one, it's putting extra load on fossil energies, coal being the primary one for Germany. And two, when we look at the power requirements for industry, that is generally a very energy intensive sector, and variable renewable energies do not really have the qualities that fit that. And so I think that is a really interesting trend to say, all right, Germany, industrial production today came out negative 2.4% month on month. And so, a significant part of the German economy is facing the repercussions of expensive energy. And where does that fit for the US? Well, the US has only added 3.7 gigawatts of nuclear since 2000. That came from 3 reactors, one in 2016, which, as we were just talking about before this call, the Watts Bar unit, that was from 1973 to 2016 when it finally connected to the grid. So 43 years, granted, some of that not really going to be active construction time. But then we look at the 2 Georgia units that came online 2023, 2020, those construction times. So beginning to connection to the grid was 10 years and 11 years. And so total US nuke, we have basically 102.5 gigawatts. And all of that is from pre-2000. And so for people looking for reliable energy, nuclear has so many attributes, but it's just been ignored for so long. And I think looking at Germany as an example, one, all in favor of getting new nuclear, but what's going to be the reliable power generation in 2024 to 2034? So that 10-year period, what are we going to do? I think that's really the question.
Yeah, I can't help myself, but was present an interesting analogy. I would say in today's world, we need power as much as we need water. Clearly, us humans have existed without electricity for many, many, many generations prior to that wonderful invention. However, staying with the idea that we need it just like we need water, if you gave someone the option to have a water well that would produce consistently for years and years and years, your reliable, delicious, clean source of absolutely necessary substance, would you take that, or would you take a rain barrel attached to the side of your house that may or may not be filled, and you can have your water when it is or when it's not?
Right.
And heavy industry has told us the answer in spades, and we can see what's happened in Germany.
I think that's a perfect analogy.
And I think really it's maybe a note to anyone just contemplating their position in either the energy industry or even just as an individual. It doesn't have to be all or nothing. We have this all too often propensity to have the pendulum swing too far, too many emissions, too much dirty coal. Let's say there's a coal-fired generator or miner somewhere in West Virginia right now that may listen in and go, thank you, somebody's finally saying this. Well, that's not true. I'm saying it again and again, but it's being mentioned again, so you're welcome. It does not have to be all or nothing. We can both increase capacity with existing sources and add renewables. We are not anti-renewable in any means. However, it needs to be mindful done in the context of where is our overall demand growth outlook, both regionally, as a state, as a nation, as a continent. How are we going to serve that best with the well-being of our citizens in mind? Because it was really, when you look back, clearly only the few that benefited, those being the companies that were subsidized and or just in many cases, maybe in Europe, just first to market with the new technology, renewable solar, that said, hey, let's get rid of these old dinosaurs. And we can look back now and go, that might not have been the best path.
Yeah, and really to your point, though, I think having that diverse mix, you have to look at, one, what are the requirements of each sector that needs this power, and two, what are the limitations of each energy? What are the attributes of each energy? Because, wind and solar has specific attributes that are great for industries right now, really feeding into crypto, for example, where they have flexible load. They can, switch on, switch off. Not all industries are like that. And so I think that's really the conversation. How do you balance your fuel mix and say, okay, we're going to have tons of energy because we want abundant energy that benefits our economy. So we also need reliability too. And that's not an attribute that we can really forsake just for one goal, which is emissions reduction.
Yeah, I think you used the right word there, balance, which is squarely that point between the pendulum swinging too far in one direction or the other. That should be the ultimate goal. And ideally, we find ourselves there. And, there's one last topic on nukes that I think is a really interesting one. Let's just say that there was a wake-up call and we decided to go out and aggressively explore building new nuclear-fired generation. Well, we've been in a 10 to 15-year period where clearly we know the numbers, and thank you for sharing them today, on what's been shed in terms of nuclear-fired generation capacity in Germany and plenty of other countries in Europe. But even in the U.S., Alex gave us the total earlier. I believe it's 3.7 gigawatts of new nuclear-fired capacity since 2002. Well, we've actually retired more capacity than that in the U.S. over that time period. So what signal gets sent to the supplier of the input? Meaning, if I'm a uranium producer, have I been told continue to produce at the same level, make more? I think the answer is clearly it would be make less. See the U.S., coal miners in 2022 sure would have been nice to have some more coal laying around. And I guess it's only as good as your ability to burn it and make a megawatt of electricity. But in this, kind of straw man case of wouldn't we have been better off with more nuclear fired generation? If that subsequently leads to, yes, let's go build it now. The first step is, are we sure that we can fuel these things?
Right.
And that question likely won't be asked. And once again, put yourself in the shoes of just who am I as an individual or as a family, and the force getting behind such a movement would need to adequately consider the cost of power as it relates to the cost of the input fuel source.
Right. Yeah, it's an interesting conversation because when you split nuclear, you have the fusion and the fission. So, historically, obviously, fission has been the only, and it still is the only, but we have this emerging massive interest really in fusion technology where leading players like Helion and others are hoping to use, whether it's, hydrogen or helium or whatever their input is, create a alternative source of nuclear. And I think there's plenty of interest in there. The timeline for that, though, I think is really ambitious right now, where you have folks saying that they're expecting to have operational plants by 2028. And just with the regulatory around nuclear, that seems like a long shot to me. Maybe I'm happy to be wrong with that one, but I think that there's definitely a gap between what people are saying, what's going to be the reality. I'd say there's only been one fusion ignition, so positive net reaction, and that was done by the Lawrence Laboratory. And Helion and all these others, nobody else has been able to replicate that. And so to say that we're going to be there in 4 years, yeah, I'm definitely short on that one.
Yeah, well, it's a good promise. Gets more dollars to flow that way. I'm just excited to think of a world where kids might know the word Tesla and not just think of the battery-powered car.
Totally.
A little further in the time machine to Nikola Tesla.
Yeah, but exciting times.
Yeah, for sure. Well, great discussion today. Thanks to listeners. Appreciate us transitioning away from trying to cover so many topics in a short period of time. Welcome comments, feedback, and look forward to our next episode on Friday, September the 13th.
Yeah, absolutely. Yeah. And just a final note for any listeners who want to go see some of the visuals about the data that I'm discussing, nuclear in the US and nuclear and wind in Germany, for example. We're going to have a chart deck that will be attached in the show notes, a link to the show notes. So definitely go download that if you want to see the numbers behind what we're talking about, and maybe some interesting takes related to the research that we put out this week. Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.